Hello friends, we will learn today the concept of financial management in this lecture. Before that, we will first learn finance and management separately. Finance includes banking, leverage, credit, capital markets, money and investments. The word finance refers to money management and other valuables which can be converted easily into cash. Finance is concerned with cash because business is directly or indirectly connected with cash. Finance includes the activities like investing or borrowing the money, saving the money, forecasting and budgeting of the money. Investment includes personal investments in stocks, bonds, debentures, certificates, deposit accounts, while money is borrowed from various financial institutions, banks, non-banking institutions by mortgage, hypothecation or pledge also. Finance is divided into personal finance, corporate finance and public finance. See the definition of finance. Finance is a simple task of providing funds acquired by the entities like companies, firms, individuals and others on the terms that are most favorable to achieve their economic objectives. Finance is the procurement to get or obtain funds and effective utilization of funds. It also deals with profits that adequately compensate for the costs and risk borne by the business. See the definition of management. Management is a guide to a group of people and coordinating their efforts for attaining the common objectives. The word management includes men, machines, material and money and methods, which are called as 5 aims of management. The term management is a continuous process which is goal oriented, accepted universally and multi oriented. It is a group activity and dynamic function. It is generally divided into top level, middle level and lower level. See the definition. Management can be defined as the process of administering and controlling the affairs of the organization irrespective of its nature, type, structure and size. It is an act of creating and maintaining such a business environment wherein the members of the organization can work together and achieve business objectives efficiently and effectively. It is intangible activity. According to F.W. Taylor, management is an art of knowing what is to be done and seeing that it is done in the best possible manner. Henry Fayol says that management is to forecast, to plan, to organize, to command and to coordinate and control the activities of others. Thus, the word financial management is the combination of the words finance and management. Financial management, concept of financial management. Financial management is the important function of every modern business organization which is the master activity. No business activity can be started without financial support. Financial management is the lifeblood of any business. Without finance, neither any business organization could be established nor could it be successfully run. Financial management is the management of finance of an organization in order to achieve financial objectives. Financial management is that part of managerial activity which is concerned with planning and controlling of financial resources of an enterprise. Funds are acquired by various sources and procurement of these funds is required. The fund procured from different sources varies in terms of cost, risk and control of funds. A smart financial manager will know that the funds should be procured at minimum cost, balanced risk and control factors. In simple words, we can say that if you save me today, I will save you tomorrow. See the definition of financial management. According to Joseph L. Massey, financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. Now, we will see the meaning of financial management. Finance is a study of money management. It may deal with the methods in which businessmen, investors, government, financial institutions and families handle their money. Financial management includes preparing cash budgets, raising money, managing flow of money, allocating and utilizing money, evaluating investments and helping in pricing policy of the products or services in the concern. Evolution of financial management. It is included in 3 phases. First is traditional phase, second one is a transitional phase, and thirdly modern phase. See first traditional phase. Financial management was considered necessary only during occasional events like takeovers, mergers, expansion and liquidation. While taking the financial decisions, the needs of outsiders like investment bankers, people who lend money has to be kept in mind. Secondly, transitional phase. In this stage, the day-to-day problems of the financial managers are given importance like fund analysis, planning and control. Thirdly, modern phase. It is important to carry on financial analysis for a company in the modern phase. Many theories have been developed relating to efficient markets, capital budgeting, option pricing and valuation models. Now see the characteristics of modern financial management system. Firstly, it is an integral part of management. Secondly, it is concerned with efficient use of capital funds. Thirdly, it is a technique of deciding the sources of capital and finding the methods of optimum utilization of available resources. Fourthly, it aims at formulating rational policies for optimum use of business funds. Fifthly, it plays important role in decision making and day-to-day activities. Sixthly, it is considered as art and science because it requires analytical skills and thorough knowledge of modern decision techniques. Seventhly, financial decisions are taken only by top business executives. Eighthly, financial decisions affect the size of earnings and risk factor. Ninth is, financial management is a continuous function and not the occasional function. Tenth is, the principles and techniques of financial management can be applied in business, industry, trade and commerce. 11th is, the nature of financial management is interdisciplinary, which uses the principles of law, economics, accounting, statistics and management. 12th is, the area covered in it involves the problem areas of money. 13th, financial management plays advisory role in every business. 14th is, it cuts across the functional disciplines like production or sales function. 15th is, it is an area of expert personnel. 16th, financial management plays an important role in social, economic and political environment. 17th is, it plays dynamic and future oriented role. 18th, it is the base of business planning and control. Objectives of financial management. Objectives of financial management are divided into 2 basic levels. First, at macro level, it includes number 1, to make an economic and intensive use of scarce resources, especially capital resources. Number 2, to operate on a sound and safe basis. Number 3, to avoid inevitable and reasonable risks of business operations. Fourthly, to procure necessary funds for business unit as indirect social responsibility. Second one is, it is operated at micro level. It includes number 1, to use a goal oriented financial structure of the concern in every business enterprise. Number 2, to achieve the goals of financial department by the financial manager. Number 3, to achieve the overall operating activities of the concerned organization. This helps indirectly in achieving the goals. Objectives of financial management. It is divided into 4 parts. First is basic objectives. It includes profit maximization and wealth maximization. Secondly, operational objectives. It includes timely availability of requisite finances, most effective utilization of finances, safety of investments, growth of the enterprise. Thirdly, social objectives, timely payment of interest, payment of reasonable dividends, timely payment of wages, timely payment of taxes, maintaining relations with financiers. Fourth one, research objectives, researching into new and better sources of finances. Objectives provide a normative framework for decision making in the business in financial area. The main objective of any business is the growth and survival. In order to survive the ups and downs in the business and to grow, any business unit must earn sufficient profits. It must also maintain the cordial relations with the investors, customers, employees and other social groups. A clear objective of business is necessary. To form such types of objectives, it is the duty of the top management. When the objectives of the financial management are clear, then other decisions relating to investments, financing and dividends are taken easily. So, primary objectives of financial management are: firstly, maximization of profits. No business activity is done without earning profits. The management has to reflect the efficiency and effectiveness in the use of limited resources. Secondly, only those activities should be taken up which increase the profit. Production should be maximized from limited resources, or the cost should be minimized for a particular level of production volume. The profit maximization is available on: firstly, rationality of person; secondly, maximization of social benefits; thirdly, effective allocation and uses of resources; fourthly, managerial decisions; fifthly, source of incentives; and sixth one, growth of the business. Now, we will see the advantages of maximization of profits. First one, every business should try to maximize the profits whenever the conditions are favorable for the unit. Second one, profit maximization has to be obtained even in the cost of social welfare. Thirdly, without profit motive, every business activity would remain on a static level, and process of every business depends upon the dynamic level. Fourthly, every business of high profitability can generate a high level of funds and can provide an incremental return to its shareholders. Fifth one, the success of every organization depends upon the efficiency of the working of the business. So, goal must be to get more and more profits. Sixthly, calculation of profits is easy. Seventh is to determine the link between financial decisions and profits. Now, see disadvantages of maximization of profits. It emphasizes the short term, it ignores the risk or uncertainty, it ignores the timing of returns, it requires immediate resources. Maximization of returns. Returns are based on amount of profits earned. If any concern earns sufficient profits, then only distribution of proper dividends to shareholders and sufficient wages and bonus to the employees are possible. So, every organization is to earn maximum returns for the satisfaction of shareholders and workers. Thirdly, maximization of wealth. It is also called as value maximization or net present worth maximization. Value is represented by market price of company's common stock or equity shares, or by net present value, that is NPV. If the wealth is maximized, if the value of the shares are increasing in the market. Wealth maximization fulfills the need of the creditors, employees, management and the society. It provides the security to outsiders and base for the wage earners. Wealth maximization is to make effective use of economic resources of the country. Now, see advantages of maximization of wealth. First one, it emphasizes the long term. Secondly, it recognizes risk or uncertainty. Thirdly, it recognizes the timing of returns. Fourthly, it considers the stakeholders' returns. Disadvantages of wealth maximization. First one, no clear relationship between financial decisions and stock price. Secondly, it can lead anxiety and frustration to management. The scope of financial management falls into important three groups. Firstly, liquidity function includes foreclosing cash flows for a specific period, obtaining funds from different sources of funds within required time, and proper management of internal funds. Secondly, profitability function includes calculation of cost of capital, fixing prices of product or services, forecasting future profits and minimizing cost of production or services. Thirdly, management of funds, management of short term and long term funds in the business organization by the financial manager. Now we will see the nature of modern financial management. Financial management includes the financial activities of business like planning, organizing, directing and controlling. These activities deals with procurement and utilization of money and assessing of needs of money, raising required money, capital budgeting, distribution of surplus, financial control. In addition to raising of funds, it is also concerned with production, marketing and other functions relating to the acquisition or distribution of funds. The financial needs of business includes evaluation of fixed capital and working capital. After deciding the capitalization, financial management has to design an appropriate capital structure of business. It includes choice of sources of finance on the basis of cost, control, risk and other factors. After obtaining the funds, they have to be allocated in different assets to ensure their effective use in the business on liquidity, profitability and safety factors. The important function of financial management is to develop sound policies, practices, control systems to ensure number 1, the availability of right amount of money at the required time and in the required form. Number 2, the effective utilization of procured money. Number 3, the proper administration of earnings of the business. Number 4, the maintenance of liquidity. Now, we will see the elements of financial management. It includes the financial planning, which is sufficient funds are available at the right time to meet the need of business. Financial control, it includes efficient asset utilization, security of business assets, shareholders introduction. Then financial decision making, it includes decisions about investment, financing and dividends are taken into account. Now, see the functions of financial management. A part, executive functions. Into that, first one is forecasting of financial requirements. Adequate cash must be available to the organization when required. Care should be taken about cash inflows and outflows, which depends upon the volume of sales. So, forecasting has been done about cash inflow and cash outflow in the next year. Second one, income management. The income will be net earnings after payment of taxes, interest to shareholders, etc. Thirdly, corporate asset structure management. The fixed and current assets of the firm must be managed efficiently to ensure success. The finance manager has valuing degree of operating responsibility over existing assets. Fourthly, decision about the investments. The allocation of capital of various investments proposals is made in order of their profitability. Each of these decisions involves risk and a finance manager evaluate the various proposals under uncertainty with the process of capital budgeting. Fifthly, Cash management. All cash with the enterprise must be managed for the benefits of owners. Financial manager should try to ascertain the better use than stakeholders outside the company. Sixthly, new sources of finance. Finance manager by forecasting should decide upon the needs and prepare the detailed financial plan for the procurement of short and long term funds. Seventh is analysis and appraisal of financial performance. Various financial statements are prepared and analyzed and necessary guidelines are set for the future. Analysis for improving the standard techniques and procedure of financial control is necessary. 8.1 Negotiations for new finance. Finance manager has to contact the source, carry on negotiations and finalize the terms and conditions of the contract after taking decisions about the needs and suitable sources. Ninth is advice to top management. Finance manager advise top management about financial matters. B part is routine decisions. Number 1, record keeping and reporting. Number 2, preparation of various financial statements. Number 3, cash planning and its supervision. Number 4, custody and safeguarding the different financial security. Number 5, credit management. Sixthly, providing top management with information on current and prospective financial conditions of the business. Now, we will see the principles of financial management. First one, organization of finances. For creation of wealth, finance should be organized. Finance should be tracked by taking into account personal loans, bank accounts, credit cards, brokerages, etc. Secondly, spend less than you earn. The principle is never spend more than you earn. The aim of any person is to control the money. For long term achievements, proper budget of earnings and expenditure is required. Thirdly, put your money to work. Time value of money is very much important. Though the amount of investment is small, in early years, saving as early as possible gives the more returns at the age of retirement. Fourthly, limit debt to income producing assets. It is the principle that every single paisa is spent to repay the debt. If you have to be in debt, you must stick to financing items that retain the value over the time factor like real estate or education. Fifthly, continuously educate yourself. For sticking up the plans for investments, understanding for investments is very necessary. Research on various plans of investments increases the knowledge about various options of investments. Sixthly, understand risk. While understanding the return of investments, the principle is more the risk, better is the return. This is called as a risk return trade off. There is always higher risk in investments like stocks and bonds where the returns are high. The risk is in the form of losing the higher capital which is invested. In case of deposit certificates or money market accounts, the risk is low compared to stocks and bonds because investments are also low and lower risk in losing the invested capital. The investments must be diversified, so the risk factor is less. Seventh is diversification of investments. There are various ways for diversification of income. Money making opportunity is a talent or a special skill. To search the ways of earning extra income from the existing income is a skill. Extra income can supplement the existing income which will change the financial profile. 8.1 Maximize your employment benefits. one should take the advantage of available benefits of taxes or out of pocket expenses or medical insurances or other perquisites available from employment. Ninth is, pay attention to taxes. Do not try to avoid the taxes, but try to manage the taxes wisely is the principle of tax management. Any money can you earn is going to be taxed. It is useful to take the advantage of relaxed tax implications for better tax planning. Plan for the unexpected. There are different types of unforeseen emergencies like unemployment, accidents, medical aids, natural calamities, emergency repairs and maintenance. For all types of circumstances, enough saving is required. It will satisfy the long term goals and financial security.